Most people looked at today's tape and saw a bad day. A 1.08% drop on the S&P, NASDAQ off 1.03%, and quietly, the VIX climbing 5% to 17.3. Here's what they missed. The number itself barely matters. What matters is the structure underneath it. Who sold, what they sold, and whether the options market saw this coming before the opening bell. Because if it did, that tells you something far more important than today's closing print. We're going to walk through exactly what drove this move, what the volatility signal actually means in context, and what the data says to watch next. Let's be precise about what happened today, because the narrative most people will read tonight is going to flatten it into something too simple. The S&P 500 closed down 1.08%. The NASDAQ closed down 1.03%. Those numbers are nearly identical, which is the first thing worth noticing. When a sell-off hits both indices almost proportionally, it's typically not a sector rotation. It's a broad risk-off event. Sector rotation looks different. One index bleeds while the other holds or climbs. Today, everything moved together, and that tells you the selling pressure was systematic rather than thematic. Now, what catalyzed it? In 2026, the market is operating under a specific macro regime. Rate expectations remain sticky, and the Fed has held longer than most models anticipated heading into the year. Any data print or policy signal that reminds traders the easing cycle is not accelerating tends to compress multiples fast, especially in rate-sensitive technology names, which carry disproportionate weight in both indices. Today's move fits that pattern. Beyond macro, you have to consider the calendar effect. We're in the latter half of June, which historically sits inside a window of thinner institutional participation. Portfolio managers are not making major allocation shifts right now. That means the marginal seller has outsized influence on price. A moderate amount of selling in a low liquidity window produces larger price dislocations than the same selling would produce in, say, late October. The actionable read here is this. A 1.08% drop in thin liquidity tells you less about conviction than a 1.08% drop in heavy volume would. Before interpreting the move as a trend, you need to check volume relative to the 20-day average. If volume came in below average today, the move is noise amplified by the calendar. If it came in above average, the move deserves more weight. The VIX closed at 17.3 today, up 5% from yesterday's reading. Let's talk about what that actually means, because the VIX is one of the most misquoted signals in retail finance. People treat it like a thermometer. High means danger, low means safety. That framing gets you into trouble fast. The VIX is derived from the implied volatility of S&P 500 options across a range of strikes and expirations, specifically targeting a 30-day forward window. When it rises 5% in a single session to 17.3, you're seeing options market participants paying more for protection. That's meaningful, but context is everything. A VIX at 17.3 is not elevated in any historical sense. The long-run average sits around 19 to 20. What you're seeing today is a VIX moving from below average territory toward average territory. That's not fear. That's normalization. Where it gets interesting is in the rate of change. A 5% single-session spike in the VIX, while the underlying index only drops about 1%, suggests the options market is pricing in the possibility of a larger move coming, not necessarily today's move being significant on its own. Traders are buying insurance against something they think might happen in the next 30 days. That asymmetry between the spot move and the VOL move is a signal worth taking seriously. Here's the framework professionals use. If the VIX spikes significantly on a moderate price decline, watch for a potential second leg lower within the next 2 to 3 weeks. The options market is not always right, but it processes information quickly and aggregates the risk assessments of some of the most sophisticated participants in the market. When vol leads price, it pays to listen. One more calibration point. The VIX crossing above 20 represents a meaningful threshold. It doesn't yet. At 17.3, you're in a zone of heightened attention, not heightened alarm. The distinction matters if you're making portfolio decisions. And just to be clear, none of this is financial advice. It's a framework for reading signals. After a day like today, the question that actually matters isn't what happened. It's what the next set of meaningful signals will be. Let's be specific about what to monitor over the next 2 weeks. First, the VIX term structure. The VIX measures 30-day implied volatility, but there are related instruments that capture 60-day and 90-day vol expectations. When short-term vol spikes above long-term vol, a condition called backwardation, it signals acute near-term stress. When the term structure is upward sloping, with longer-dated vol higher than near-term vol, it signals that traders expect current turbulence to fade. Right now, with the VIX at 17.3, checking whether the term structure is in contango or backwardation gives you a much sharper read on whether institutional participants think this is a one-day event or the beginning of a repricing cycle. Second, watch credit spreads. The high-yield credit spread, the premium that speculative grade borrowers pay over treasuries, is one of the cleanest leading indicators for equity stress. Equity markets can be noisy and driven by sentiment. Credit markets are transactional and slower to react, which means when credit spreads widen meaningfully, the signal carries more weight than a single day's equity move. If spreads stay contained over the next 5 sessions, today's equity weakness is less concerning. If spreads start moving, that's the equity market getting confirmation from a more rigorous instrument. Third, watch how the mega-cap technology names behave in the next rally attempt. These stocks, the top 5 to 7 by market cap in the S&P 500, account for a disproportionate share of index weighting. If the next bounce is broad, it suggests today was absorbed cleanly. If the rally attempt is narrow and fails on the 3rd or 4th day, that's a distribution pattern. Institutional investors use rallies to reduce exposure when they've already decided to de-risk. Narrow failing rallies are how they do it. The macro backdrop in June 2026 means the market is sensitive to any data that pushes rate cut expectations further out on the calendar. Any inflation print, labor market data, or Fed commentary that lands between now and the end of the month deserves close attention. That's the fundamental variable driving the regime right now. And until it shifts, the pattern of compression on any hawkish-leaning data is likely to continue. We open by saying the number barely matters. It's the structure underneath that tells the real story. Today's 1.08% drop in thin June liquidity, paired with a VIX normalizing rather than panicking, and credit spreads that haven't confirmed the equity weakness. That's a picture that calls for attention, not alarm. The follow-up question we'll be watching. If the VIX crosses 20 before the end of June, what does that historically mean for July returns? That's the next video. Subscribe so you don't miss it.